Most years, the market gives you something to argue about. Is growth accelerating or slowing? Are rates too high or about to fall? Is this a bull market with problems or a bear market in disguise? 2026 doesn't feel like that. It feels heavier. Not because something's breaking, but because a lot of things we've been leaning on quietly stopped working. Power grids, supply chains, balance sheets, politics. Even the idea that markets will smooth everything out if we just wait long enough. This isn't a fear year, it's a constraint year. And constraint years are uncomfortable because they don't give you villains. They give you math, they give you physics, they give you trade-offs. We spent the last decade in a world where money was cheap, efficiency was king, and diversification mostly worked, whether you understood it or not. That world trained us to believe that time fixes everything. But time only fixes things when capacity exists. In 2026, the question isn't, what's the next big theme? The question is, what runs out first? Power, labor, liquidity, political patience? Because when markets stop pricing stories and start pricing limits, the rules change. Quietly at first, and then all at once. If you're still investing like the world is frictionless, this year is going to feel frustrating. If you understand where the system tightens, it won't. Let's talk about why. 2026 isn't a theme year. It's a constraint year. Every year markets try to crown a theme, because themes make you feel in control. It's the AI year, the election year, it's the rate cut year. And then everyone argues about whether the theme is bearish or bullish, as if markets are a single lever you pull. But 2026 isn't one lever. It's multiple systems tightening at the same time. That's the difference. This isn't 2017, when growth was fine, inflation was tame, and the world felt basically frictionless. It's not 2021 either, when money was free, demand was exploding, and everyone could confuse tailwinds for genius. 2026 is what happens after all of that. It's what happens when you're still trying to fund the future while paying for the past. The constraints are physical. Grid capacity, labor, permitting, supply chains that no longer optimize for cost. They're financial, higher debt loads, tighter liquidity, less tolerance for duration risk. And they're political, because policy is now part of the production function. If you want a historical parallel, this is closer to the mid-late 1960s than people admit. Strong nominal growth, policy ambition, big capital projects, and the first hints that inflation isn't transitory because the system itself is changing. It's also got a little 1999 in it. A real technological revolution paired with the market's tendency to overshoot the timeline. The opportunity in a constraint year is that the market stops rewarding broad optimism and starts rewarding positioning. Owning the market still works sometimes, but it works in a way that feels less like sailing and more like whitewater rafting. You get there, but you better know which rocks matter. The risk is the one everyone hates. Not a crash, but a long stretch of returns where the index goes sideways and the winners rotate. That environment exposes weak portfolios, weak balance sheets, and weak stories. That's the setup. Now, the first constraint everybody talks about, and almost nobody treats correctly. AI has graduated from a narrative into a build-out. That matters, because build-outs don't behave like hype cycles. Hype cycles are priced on imagination. Build-outs are priced on inputs. We've done this movie before. The internet boom wasn't just pets.com. It was fiber towers, routers, data pipes, the physical stuff. And the punchline is, the infrastructure got built, the productivity showed up later, and the equity market had a very painful time in the middle sorting out who was real and who was renting the future. AI is like that, except even more physical. Compute turns into power. Power turns into grid access. Grid access turns into permitting. Permitting turns into politics. And politics turns into timelines that don't care what your CEO promised on an earnings call. So the economic question isn't, is AI transformative? Of course it is. The question is, what breaks first? And what breaks first is rarely the model. It's the system around it. The historical backdrop here is electrification. Factories bought electric motors long before productivity surged because they had to redesign workflows to exploit electricity. AI is similar. The first wave isn't magic, it's messy integration. The biggest wins show up first in places where the workflow is already measurable. Logistics, fraud detection, customer support, coding, industrial automation, healthcare administration. Not because those are sexy, but because they're legible. The opportunity, if you're investing, is not just AI growth. It's the barbell. On one side, the enablers that sell scarce inputs, semis, networking, thermal systems, power equipment, grid capex, specialized real estate. On the other side, the adopters where AI translates into margin expansion rather than just a press release. The risk is that the market keeps pricing AI like software. Fast adoption, high margins, smooth scaling. When the reality is industrial, capital intensity, bottlenecks, and politics. If you want the cleanest way to say it, the risk isn't that AI fails. The risk is that it succeeds slower than the multiples require. There's another risk nobody likes to say out loud. When CapEx surges into one part of the economy, it can crowd out CapEx elsewhere. The market loves the hero sector until it realizes the hero sector is consuming all the labor, all the equipment, and all the power. So AI is real. It's durable. It's also going to be choppy and uneven. That's not a bug. It's history. For 30 years, globalization was basically a cheat code. You optimized for cost, you built supply chains across continents, you treated politics as noise. And it worked, until it didn't. Now the objective function has changed. The goal isn't cheapest supplier anymore. The goal is resilience, redundancy, security, domestic capacity, control of critical technologies. That is intentional inefficiency. If you want the historical analog, it's the post-World War II era in reverse. Back then, we built integrated systems and rules to reduce conflict and lower costs. Now we're watching regions rebuild parallel systems. Different standards, different rules, different tech stacks. That fragmentation is inflationary because it's duplicative. And inflationary doesn't mean CPI goes to the moon. It means the floor is higher. The opportunity is that markets still routinely misprice geopolitical persistence. They price shocks. They underprice regimes. A regime shift means defense spending doesn't fade when headlines fade. Energy security doesn't fade. Critical minerals don't fade. Cybersecurity doesn't fade. Currency hedging starts to matter again. The risk is episodic repricing. Markets can ignore geopolitics for a long time, till suddenly they can. And when that happens, it doesn't look like a neat forecast. It looks like a one-week move that makes everyone feel stupid. And yes, there's a US risk embedded here too. If global capital starts to feel less emotionally committed to funding US deficits at any price, you can have a scenario where the dollar and long rates stop behaving like the automatic shock absorbers investors assume they are. Not guaranteed, not imminent, but the range of outcomes is widened. That's what the multipolar world does. It doesn't end the game, it changes the rules mid-hand. The consumer is almost always framed as an either-or story. Either the consumer is invincible or the consumer is collapsing. The truth is more annoying. The consumer is uneven, and the unevenness is the entire story. Higher income consumers live in asset land. Their balance sheets are supported by markets, home equity, and stable employment. Lower income consumers live in price land, where housing, insurance, and services inflation are the tax they pay every month just to exist. Historically, this is not new. The late 1990s and mid-2000s both had versions of this. Strong aggregate numbers with hidden stress. The difference now is the composition of inflation. Goods inflation cooled, but the sticky, lifestyle-defining components stayed elevated. The opportunity in a K-shaped consumer environment is that you get clear winners and losers. Premium brands can still work. Value leaders can still work. The mushy middle companies that don't have pricing power and don't have a value proposition, they get eaten alive. The market stops rewarding good enough. The risk is that macro forecasts keep missing because averages keep lying. If you're running a portfolio or a business, your average customer doesn't exist. The distribution exists. And in 2026, the distribution is destiny. Also, rate cuts, if they come, will not be a universal gift. Cuts relieve interest-sensitive stress at the margin. But if inflation stays structurally higher than the 2010s, then the consumer ceiling stays lower, even as the floor stays supported. That creates the most frustrating environment of all. Okay growth, okay earnings, but constant disappointment versus hope. People talk about infrastructure spending like it's a political trade. It isn't. It's maintenance. Deferred maintenance with a deadline. You can't digitize everything without power. You can't scale AI without redundancy. You can't electrify transportation without grid upgrades. You can't compete in a fragmented world without defense capacity and cybersecurity. If you want a historical analog, it's the post-war build-out. Except now, it's happening inside an already built society that has to retrofit itself while still running at full speed. Retrofitting is always more expensive than building from scratch. The opportunity is that this is one of the few areas where spending is non-discretionary. It doesn't mean every stock is cheap or every project is a winner. It means the demand is durable. The system has to spend. The risk is execution. Infrastructure stories die in the gap between approved and delivered. Cost overruns, labor constraints, permitting delays, and political reversals don't show up in models the way they show up in reality. There's a portfolio risk here too. When everyone crowds into safe, durable CapEx, valuations can get stretched. People forget that boring doesn't mean riskless. It just means the risk arrives through delays and margins, not headlines. This is the chapter you're asking me to actually fill in, so let's do it. High valuations do not automatically mean the market is about to crash. They mean the market is less tolerant of error. That's a different claim. When multiples are elevated, you're not buying earnings. You're buying the future story attached to those earnings. And in 2026, the future story is competing with constraints. That creates a particular kind of market, one that looks calm at the index level, but is ruthless beneath the surface. Stocks gap down on small misses. Winners become narrower. The market stops handing out participation trophies. Historically, this kind of environment shows up late cycle, but it also shows up in transitions, like 1968 to 1972, when quality became a trade, dispersion widened, and the market's idea of safety got very expensive. Or 1998 to 2000, when a real revolution got priced like it would arrive tomorrow. The opportunity is that dispersion is a stock picker's market. Quality is not a cliche here, it's math. Strong balance sheets, pricing power, resilient cash flows, and credible management matter more when the market is intolerant. The risk is complacency through indexing. If your entire plan is to own the market and let it work, you may still be fine over long periods, but you should expect a rougher ride and a higher chance of dead money intervals. Elevated valuations create a world where timing matters more, and set it and forget it feels worse emotionally, even if it eventually works. Private markets add another layer, liquidity risk. Holding periods stretching beyond 7 years isn't a trivia fact. It's a sign that the exit machine is jammed. It doesn't mean private assets are bad. It means their returns are now partly a function of time and financing, not just operating performance. In other words, you don't just underwrite the business, you underwrite the exit. A lot of people keep calling this higher for longer like it's a slogan. The real change is simpler. The cost of money is no longer theoretical. In the 2010s, capital markets were a tailwind. Issuance was easy. Refinancing was easy. Duration was rewarded. You could paper over weak business models with cheap debt and an optimistic multiple. In 2026, capital is available, but it's no longer forgiving. Rising issuance, corporate, municipal, and structured credit means supply is back. Supply changes the balance of power. Investors can demand better terms, and they will. It's what markets do when they're not starving. Historically, when issuance surges, you have to watch two things: underwriting standards and the price of duration. As spreads stay tight while supply rises, the market is telling you either the demand is real or the risk is being underpriced. Both can be true at the same time for a while, until suddenly they aren't. The opportunity is that in a world where money is real again, you can build portfolios around income with structure. Not just chasing yield, but selecting where you're actually compensated. You can find value in parts of credit when the equity market is priced for perfection. The risk is that investors repeat the same mistake with a new wrapper, reaching for yield with no margin for error, taking duration without compensation, or buying safe credit that is only safe if rates and inflation behave nicely. And 2026 is exactly the kind of year where they might not. This is where people get angry, because the whole point of diversification is peace of mind. And in recent years, diversification has not provided peace of mind. Here's why. A lot of portfolios are diversified by ticker, not by driver. They own US growth stocks, international growth stocks, private growth funds, venture, and maybe some credit that's correlated to the same growth assumptions. That's not diversification. That's one bet wearing different outfits. The historical backdrop is important. The 2010s trained investors that duration was a hedge and correlations would behave. That was a unique period. Low inflation, global integration, central banks as shock absorbers. A multipolar world with higher structural costs changed that. Trade fragmentation, industrial policy, and supply chain redundancy all raise the probability that inflation stays sticky and correlations behave differently. Bonds may still diversify in certain shocks, but you don't want to build a portfolio on one hedge working perfectly. So what's the opportunity? Building diversification around different economic engines. Scarce real assets, durable cash flows, selective credit, and exposures that are not just leveraged versions of the same growth narrative. What's the risk? Thinking you're diversified because you own a lot of stuff, when in reality, you own the same factor, duration and growth, over and over. 2026 is the kind of year that reveals that. 2026 is offering something markets don't always offer. Clarity. Not certainty, clarity. It's telling you where the bottlenecks are. It's telling you which stories are constrained by physics. It's telling you where capital is still being mispriced. And it's punishing the things that worked when money was free and the world was integrated. Lazy beta, sloppy credit, fake diversification, and narratives priced like they arrive on schedule. This is not a call to be bearish. It's a call to be grown up. In a constraint year, the edge isn't prediction. It's construction. What you own, why you own it, what it's sensitive to, and whether you're getting paid for the risks you're taking. That's the real game in 2026.